interesting fact, incomes were actually rose. So incomes rose. That can be inflationary. Incomes rose, but spending was down. So what this tells us is that the average household is concerned. We talked about consumer sentiment. It's down. It's as low as it's been in a very long time. And so although incomes are up, it's normal for Americans to spend every dollar they make. And so this is interesting. People are holding on to their money a little bit more. I think that is obviously in anticipation of the uncertainty, potentially pending recession. And look, since I've mentioned recession like 5 times already in this podcast, I think it's important to point out, recessions aren't typically bad for the housing market. Matter of fact, in most recessions, besides the great meltdown that we had in 2008, usually it's good for housing. And it's good for housing because interest rates come down during a recession, and that spurs activity, and it's typically good for the real estate market. So I just want to point that out. When you hear me say recession, I sometimes might say it with a little bit of a grin. I don't want a recession because that's pain for a lot of people. But in the mortgage industry, it's one of these weird phenomenons where we tend to do well during a recession. And so although it's not what we want, I would rather have a strong economy and a strong housing market. That's ideal. But this will force interest rates down. To me, it begs the question if the current administration knows that they can't impact Jerome Powell and the Fed, and that they have to create circumstances that will require them to lower the Fed funds rate. And some of the moves that are being made and the disruption that it appears to be creating might make you wonder, is some of this intentional to temporarily slow down the economy, bring the interest rates down? I don't know. Maybe that is, maybe that's too big of a, of an idea. I don't know. But look, there's a part of me that goes, I wonder. So consumer sentiment down. I mentioned that. And consumer sentiment is one of those leading indicators. And part of consumer sentiment looks at what consumer sentiment is today, and it looks at forward-looking consumer sentiment. And the forward-looking number is even worse than the current number. So look, the consumer is not feeling good right now. They're very uneasy. Now, could that spill over into real estate? Like, let's be honest, if you're the average consumer and you're concerned about the market, you may not know what we know, which is that interest rates get better, affordability comes down, and buying a home is something you should be considering during a time like this. But let's be honest, the average consumer doesn't think that way. They think market bad, I'm going to hold on to everything. Why would I buy a house right now? That's really scary. So we have to understand that and be willing to talk through that with our customers. But the forward-looking consumer sentiment number, it was even worse than the current one. So that's not good. And consumer expectations around inflation, you guys, this will blow your mind. The consumer expectations. Now, again, this is not what the market's predicting. This is what the consumer is predicting, is that inflation is going to reach 5%. Now, I do not think that is going to be the case. I do not see a circumstance in which that happens. We've talked about the tariffs. We've talked about the stuff. Nothing to me indicates that, but that's what consumers think.